really wanted to make this video. I actually wrote a whole email, sent it to my investors, but I felt like this one deserved its own video. If you're watching this for the first time, this is not applied to conventional financing, FHA, owner-occupied properties. This is solely for investment loans. If you're an investor and you're buying an investment building, okay? When you're shopping for your deal, securing financing, there's several ways that you can shop around for the lowest rate. Number one is credit score. It's the most obvious. You're going to get priced based off your credit score. Most banks will require a 680 FICO score to do the deal, but there are a few banks that will do it at the 640 FICO, okay? That's a minimum requirement. Anything under 700, you're getting mediocre pricing. If you hit the 720 mark, you're pretty good. And anything over 740 or higher, you're going to get top tier pricing, best rates. Number two is the ARMs, right? These are adjustable rate mortgages. So what you're going to do is you're going to ask the bank for ARM options, right? 5 ARM, the 7 ARM, or the 30-year, right? Just ask the bank, right? To give you those options. Typically, your 5-year adjustable rate mortgage, it's going to be the cheapest rate. And what it is the rate is going to be fixed for 5 years. It's still a 30-year amortized loan, okay? But it's going to be fixed for 5 years, and then it's going to adjust after year 5, okay? That's typically the cheapest rate. Number 3 is going to be the prepayment penalties. So when you apply the prepayment penalty, it's going to come with a less expensive rate, with a cheaper rate versus no prepayment penalty. If you don't have a prepayment penalty, the bank's going to make sure that they get their money back. So you're going to have to pay a higher rate. But what you can do is you can ask the bank to compare options with the prepayment penalty, without a prepayment penalty. I just want to have you guys keep in mind, this also depends on your exit strategy. And this means that if you know you're going to sell the building in, let's say, 12 months or 2 years, or you know you're going to refinance on it and you have that in your mind already, don't add the prepayment penalty, okay? There's various types of prepayment penalties, and what that means is that you're going to pay a percentage off the principal balance if you sell it or refinance before the prepayment penalty is over. All right, then the next one is your buy down options. So all banks have various buy down options, but typically a 1 point buy down option, keep in mind 1 point is equivalent to 1% of the loan amount. A 1 point buy down option, roughly more or less is about 0.25% less on the rate, so 25 basis points less, right? So really run your numbers. You can ask the bank to compare buy down options to see if it makes sense for you to invest the money up front, and then in the long term you have monthly savings on that buy down. The last one I'll mention is the type of deal, the type of building, the type of real estate that you're purchasing, whether it's a 1 to 4 unit, single family, condo, mixed use, fully commercial, strictly commercial building. Type of deal really matters, and it's going to determine the rates. Different banks, I will say, have different appetite for certain deals. Some banks will not touch commercials. Others will only do mixed use if the residential is 51% compared to the commercial. So knowing the type of banks that have an appetite for specific deals can help you shop around for the best rates and terms. It really depends on the real estate, really depends on the deal. And as always, if you have a deal that needs pricing, or just a very difficult to do deal, or if you're just rate shopping, send it over to us. My team and I will price it out for you.